My name is Maria Clayton, and I am a senior manager at M&P. I am delighted to have the opportunity to address you for a few moments prior to today's webinar. M&P is a leading national accounting, tax, and business consulting firm. We proudly serve the responsive needs of our clients in the public, private, and non-for-profit sectors, and we are committed to helping our clients, teammates, and community adapt to evolving landscape. We are proud to support organizations like the Chamber of Commerce and a partnership that aligns with business spirit and amplifies our values of leadership, excellence, commitment to enhancing our communities of where we work and live. Thank you for taking part in this session, and I look forward to connecting with you at a future Chamber event.
Hello! Thank you for taking the time to watch this brief video on RRSPs put together by the Steele Group Financial. Today, going over the various details around Registered Retirement Savings Plan will be myself, Cliff Steele, Mark Weasel, and Mario Moto.
Hello, I'd like to start by introducing you to who we are, the Steele Group. I am Mark Weasel. You met Cliff Steele earlier, and we also have Mario Moto. We are the three partners of the Steele Group, which was founded in 1996 by Norm Steele. Together we manage over $400 million of individual wealth assets. There's 12 total team members, lots of support to kind of help us in this work we do. We are an independent brokerage, so what we mean by that is we aren't beholden to any one company. We can kind of shop the world to find the best products for our clients as opposed to being stuck with one company to work with. And altogether we have over 50 plus years of work experience.
And as Mark mentioned, we do have a tremendous amount of different investment options for clients, but before we pursue any options with clients, we take a financial planning first approach. We're all CFPs by trades, which means that we look at your individual goals, objectives, and try to take into account all the moving facets of life, whether you're looking at your company pension plan, government benefits, or personal investments or private investments. We want to make sure that we factor all those items together with taxation, with your specific family needs, your state needs, and all your various ambitions throughout your lifetime. We look at things like inflation, risk protection, and combine it all into a summarized written plan. And from there, we discuss what options are best to use within your plan itself. Now we'll get into the agenda of this presentation. So the core focus of the presentation itself is going to be on registered retirement savings plans. However, it's important before we get into the account type itself to actually understand all the ranges of accounts that are out there, looking at the understanding of income and the impacts it does have on RSPs and other investment options, running through a couple examples of earning income outside of an RSP versus other investment structures, and then getting into various reasons why we might touch RSPs before retirement, some myths around the program, and a few other bits of interesting information. So now to get started, we move into the differences between various accounts. And our industry is notorious for what I call alphabet soup. You'll see different bits of acronyms and names, but for the sake of today, we're going to keep it very high level, focused on RSPs, but we'll touch on open accounts, which are non-registered, tax-free savings, and a newer account type called the first-time home savings account. So first of all, it's important for individuals to understand that earned income is actually a broad term. Many individuals look at it as employment income when they're working. However, while you're working, if you own a rental property, it's generating rental income. If you have done a good job at saving throughout your lifetime and you have $100,000 in your bank account, in today's interest rate environment, you might earn 5% on high interest savings, meaning that's earned income. So I do run an example here of someone earning 5% equaling $5,000. And while it always feels good to earn some income, it's like moving 3 steps forward and 1 step back because you have to give some to the government. And in that process, we start looking at the importance of after-tax income. So taking that example a step further, and we look at a 10-year time frame of earning 5%. Not only do you pay taxes that first year, you're paying taxes every single year. And at the end of the day, it's always good to go 3 steps forward, 1 step back. Over a long period of time, you are still going to move in the right direction. You're going to grow your wealth. However, the ability of using an RRSP, tax-free savings account, or various registered accounts allows you to do something very important, which is deferring your income. As you look at this table, one thing you're going to notice on the far left-hand side It is the ability that you don't have to pay taxes on this amount annually. So at the beginning of the following year, you have more income earning 5%, and it compounds and it grows, and over a very long period of time, you have over $20,000 of extra income accumulated in the account. So it makes a tremendous difference on applying the concept of tax planning and looking at various accounts to find the right home to save over the long term. Now, as we move on to the next table, I'd want to elaborate a little bit further between the various account types. Obviously, the non-registered account, as mentioned, is just like a traditional savings account, but it can also be an investment account holding stocks, bonds, and other investments. There is no real restriction on the amount of money you can put into that account. You can save as much money as you want across many institutions or one institution. However, once you get into the registered account space, there's a lot of government regulations and restrictions. Tax-free savings accounts are very much based on your age and how much years accumulated room you might have available, while an RSP will be very dependent upon your earned income throughout your lifetime. There's certain restrictions and allotments throughout your lifetime that you can add into the account, and there is unused room that does carry forward within both tax-free savings accounts and RSPs. And the first-time home savings account might feel like an RSP, but it only has a carry forward room when you have an account open. So there are different situations where you'll use each of these accounts. So for the benefit of the deferred income, obviously you have a lot of tax savings, a lot of growth opportunity, but it does come with some complexity that needs a little bit of a deeper look. So we're going to go a little bit deeper into the actual RSP account itself.
So effectively how an RSP works, I'll use numbers, right? If I earn $80,000 and I take $10,000 that I've earned and I put it in an RSP, I don't pay tax on that $10,000. So if I was in that 30% tax bracket, I may have even lowered my tax bracket now, right? But that $10,000 I put in, I don't pay the 30% I would have paid on it in taxes. Ideally in retirement, when I need that money and I pull it out, hopefully I'm in a 20% tax bracket. So I've saved myself effectively that spread in taxes. On top of that, I've also grown that $10,000 for those many years tax-free within it. Right, and accumulated a lot of growth that I don't pay tax on until I redeem it. So yes, it is taxable when it comes out. That's ideally in retirement at a lower tax bracket, and that's why an RSP makes sense. It has an annual contribution limit, so you can't just put in whatever you want. It does accumulate if you haven't used it in prior years. In that 71, it does have to be converted to a RIF, and you have to start taking something out if you haven't prior to that. Within an RSP, sometimes we meet with clients and they want to come in and they say, I want to open an RSP account, I want to invest in an RSP. An RSP is the best way to think of as a vehicle, but what you want to hold in that vehicle. So same thing with like a TFSA, right? It's a vehicle, and maybe you want to hold some kind of investment within it. So there's various investment options. This is just a few of them, right? There's cash, so you can hold a high interest savings account in there. Right, you could hold fixed income, so bonds where you might make a little bit of money with a little less volatility. You could hold stocks. You could hold commodities. You could hold cryptocurrencies in some formats, right? You could hold mutual funds, which is very, very common, exchange traded funds. So you use these to kind of grow your investment, your cash, your wealth over time, and eventually pull it out in a tax deferred status. As the name implies, RRSP, Registered Retirement Savings Plan. The vast majority of the time, an RRSP is going to be used just for that, to pull money out in retirement, for that long-term savings. But there might be specific circumstances where you might use it before. By far the most common situation where that happens is to buy your first house. There's a specific plan called the First-Time Home Buyers Plan, where you're allowed to pull out $35,000 tax-free, but you have to repay it over 15 years. So it can be a bit complicated. There's a bit of rules around that, but that is the number one reason why you might pull money out of an RSP before retirement. All the rest would be very situational, where you take a sabbatical from work and your income's very low, and it might make some sense to pull some RSP money out, and again, at a lower tax bracket. Right? What you don't want to be doing is funding that favorite trip of yours while you're fully employed using your RSP, because now you're taking your earned income, let's say again $80,000, and I'm pulling out $15,000 for this amazing cruise I want to go on, and I'm adding that directly to my taxable income. So now it's not 80, it's 95,000 I earned.
As Mark was alluding to, the primary purpose of RRSPs is to fund your retirement. Now, how does that actually happen? You may have heard lots of things that, registered retirement income funds, RIFs, LIFs, all these sorts of words about, what happens to your RRSP someday. So we wanted to shed some light on that. So registered retirement savings plan, or RRSPs, normally are converted to a registered retirement income fund, or a RIF, when you're ready to retire. Now, you might hear lots of different options. Do you really need to convert it to a RIF? There are pros and cons of doing this, so we wanted to go through a little bit about how that works. Most people, we do recommend you convert your RRSP to a RIF if you are retired. Retired meaning you're no longer going to have employment income. Some clients, they might be dabbling with the idea of retirement, so they might not want to convert their RRSP to a RIF, because as soon as you convert an RRSP to a RIF, it is going to have a mandated minimum income that needs to be paid out every year based on your age and the size of the investment account every year, January 1st. So if you're not sure you're going to be going back to work, you really shouldn't be converting your entire RRSP portfolio into a RIF. Now, if you know you're done, you're not going to go back to work, your taxable income is going to be just what you draw from CPP, OAS, maybe a pension, and then your retirement accounts, your RIF, converting your RRSP to a RIF makes sense. The reason for this is if you are 65 or older, or your spouse is 65 or older, income from a RIF and other pension sources are income splittable. Meaning, if you have a RIF and your income you draw out of that for a year is $50,000, you would be able to income split that, $25,000 for you, $25,000 for your qualifying spouse, bringing down your marginal tax rate even further. Further adding to the value of using an RRSP to begin with, because when you put the money into the RRSP, you saved at a higher tax level, ideally, than when you're drawing it out in retirement. So the ability to income split with a qualifying spouse really adds a lot more value to the whole RRSP RIF program. One more important feature of an RRSP and a RIF is that you do have to convert your RRSP to a RIF December 31st, the year you turn 71. This is kind of a big misconception we hear from clients. People think they have to convert it at 55, 65, 70, but it is actually December 31st, the year you turn 71. One other important item to note with a RIF, the Registered Retirement Income Fund, is that it doesn't change the investment options. A lot of people will come to our office and say, I'm ready to retire. I'm now going to convert my RRSP to a RIF. Does this mean I need to buy GIC or an interest product or a payout annuity we sometimes hear? But an RRSP and a RIF are merely the account structure. You can have whatever investment types you wanted in your RRSP as well as your RIF. Just by converting your RRSP to a RIF doesn't mean you have to liquidate your holdings or become a very conservative investor all in interest-bearing products. Now, most clients do become a little more conservative as they approach retirement, but it is not mandatory. So now that we've gone over how RRSPs operate and the benefits of them, how they convert from RRSPs to RIF to provide you a retirement income, we did want to take a moment to go over some of the myths that we have encountered over the years that people have around RRSPs. Often one we hear is you should always contribute to an RRSP, or always shouldn't. One thing that we always want to make very, very clear is that financial planning, the use of an RRSP or a TFSA, really comes down to your unique situation. There are a lot of social media influencers, people on various social media apps like TikTok and Instagram, where you can go on and see things like, RRSPs are terrible, you shouldn't use them, or we should only use a TFSA. And that might be true for certain people, but everyone's situation is very unique. If you have a very, very high taxable income, and in retirement your income is going to be lower, maybe with splitting with a qualifying spouse, an RRSP makes great sense. If you have a very low income or a lower income and you expect your income to rise in the future, a TFSA might make more sense for you now and an RRSP might make more sense in the future. So there are no absolutes when it comes to financial planning. Other things we see online all the time or hear from clients is, well, I should only use a TFSA. The TFSA is the new thing, the RRSP is the old thing, so that must mean the TFSA is better. Not necessarily the case. Yet you might use them in conjunction. You might put some money in an RRSP to a point, bringing down your taxable income, and then the balance goes into a TFSA. Other things, myths we see, and Mark went over that in great detail, is RRSPs are only for retirement, which is not necessarily the case. RRSPs can be used for many, many different things. You should always max out your RRSP. This is definitely something that you don't always have to do, again, unless your income really warrants it. When we looked at our marginal tax system in prior slides, we saw how as you can bring down your taxable income using an RRSP. You might be in a situation where you make, say, $40,000 a year and you want to put $5,000 into an RRSP. Well, that's great. You're going to save at a 20% tax bracket, but now your income is even lower. So putting in another $5,000 might not save you as much or anything by putting more money into an RRSP. Withdrawals from an RRSP are always very taxed, or are taxed very heavily. This can be a little confusing. They are taxed quite heavily if you're still working, as Mark mentioned in the past. You're pulling money out to buy a hot tub or some sort of vacation you wanted to go on where your income was already at 80, pulling out 10 grand pushed you up to 90. That is true. You are going to pay a lot of tax on doing that. But the idea is to put money into your RRSP while you're working, taking it out at retirement at a lower tax bracket. The last one, and we hear this in lots of different cases, is this particular account, RRSP, TFSA, whatever it is, can only buy high interest savings or an interest-bearing product of some kind. We always like to stress to clients that the account type, be it RRSP, TFSA, First Home Savings Account, or DSP, whatever it is, doesn't predicate what the investment options are. You can have those accounts in absolutely anything. Hopefully that helps shed some light on some of the myths you may have heard about RRSPs and other registered accounts.
Obviously, as myself, Cliff, and Mark have outlined throughout the presentation, it really comes down to your personal situation, whether an RSP makes sense for you today or makes more sense for you tomorrow. At the end of the day, there's a tremendous amount of resources out there within the industry. Our office is always available at the service now at thesteelegroup.ca, and also directly in office, face-to-face, Zoom, whatever is easiest for yourself to go through some of the various options. We have a tremendous library of resources on our website, and also in person. We cannot stress enough the importance of working with a certified financial planner and ensuring that whatever account type you're using, whatever investment vehicle is right for you, works with your overall goals and long-term objectives.